This weekend, clients of Silicon Valley Bank are scrambling and imploring the federal government to step in.
Silicon Valley Bank's collapse set off a panic not seen since the days of the financial meltdown of 2008.
The ripple effects from the collapse of Silicon Valley Bank on Friday are being felt across the world.
It is and should be a matter of concern.
Silicon Valley Bank is the largest bank to fail since 2008 financial crisis. Over 95% of Silicon Valley Bank's deposits are not insured under FDIC due to being over $250,000 limit. That is over $160 billion in uninsured customer deposits. About half of all venture capital funded startups in the US are customers of SVB. That's 65,000 startups. This means that 65,000 startups could miss payroll. This can create huge problems for the startup and tech economy. Now, before that, let's understand what a bank run is. Basically, a bank is a company that borrows short-term and lends long-term. Checking accounts, for example, represent money that a bank borrows from depositors. The bank has to give that money back to depositors when they want. If you go to an ATM or teller and withdraw your money, you get it instantly. Banks do not pay very high interest on checking accounts or other short-term liabilities. Meanwhile, the bank invests in long-term assets, mortgages, for example, or business loans that generate a high yield but cannot be liquidated quickly, or at least not at full value. The difference between the high yield on your long-term assets and the low cost on your short-term liabilities is called the interest rate spread and is the most important way banks make their profits. But this is risky business. Because assets are long-term illiquid things, they can't be sold quickly for their full value. So if all the people who lend money to the bank, say, depositors, come asking for their money back at once, the bank simply won't be able to pay them all. This risk is called a maturity mismatch. And when all the lenders ask for their money back at once, it's called a bank run. In the 2008 financial crisis, there were many very complicated crises and crashes that were like bank runs, happening to companies and other entities that were like banks. Economists have spent years tweaking their traditional bank run models to try to describe these bizarre events. But in the case of Silicon Valley Bank, the rush was a completely normal, classic bank run, the kind shown in movies like Mary Poppins.
Stop all payments! Stop all payments!
And It's a Wonderful Life.
I just did, but they said you left. This is a pickle, George. This is a pickle.
All right, now what happened? How did it start?
Well, how does a thing like this ever start? All I know is the bank called our loan.
When?
About an hour ago, I handed over all our cash.
All of it?
Every cent of it, and still was less than we owed them.
Holy mackerel!
Economists understand this type of execution very well. In fact, last year Douglas Diamond and Philip Dybvig won a Nobel Prize for making a model of it. The key to a classic bank run is called sequential service. Basically, in a classic run, whoever tries to get their money out of a bank first will get it all out, while latecomers will lose their money when the bank fails. This means that runs are self-fulfilling prophecies. As soon as a critical mass of people think a bank run is likely, everyone rushes to withdraw their money at once in an effort to get ahead of everyone else. And this stampede is racing. Normally, FDIC insurance prevents this type of foreclosure from happening. Because everyone knows the federal government will cover their deposits, they aren't worried about losing their money in a rush, so they're never in a rush to get it out. And because they never rush to get it out, the races can't even begin. For a typical bank, approximately 50% of deposits are FDIC insured. But 93% of SVB's deposits were not FDIC insured. So SVB was vulnerable to a classic textbook bank run. Why did SVB have so many uninsured deposits? Because most of their deposits came from startups. Startups typically don't make much. They pay their employees and pay other bills with the money they raise by selling stock to venture capitalists. And meanwhile, while they're waiting to use that money, they have to put it away somewhere. And many of them put it on account at Silicon Valley Bank. If you're the founder of a startup, why would you keep your money in a weird little bank like SVB instead of a big safe bank like JP Morgan Chase or in treasuries? This is actually the biggest mystery of this whole situation. Some companies put their money in SVB because they also borrowed money from SVB, and keeping their money in SVB was a condition of their loan. For others, it was a matter of convenience, since SVB also provided various financial services to the founders themselves. For others, it may have been just the vibes and hype. Maybe you used SVB because you're a startup, and that's just what banking startups use, duh. And groupthink, too. About half of all startups used SVB, according to some reports, so perhaps people are putting their money into it because their friends and acquaintances are, too. However, accepting huge deposits from startups instead of individuals and small businesses has made SVB a very strange bank, leaving it vulnerable to a run. What started the run? The next question is what started the career at SVB. There are basically three possibilities here. 1. A self-fulfilling prophecy. 2. Concerns about the value of SVB assets. 3. Withdrawals due to worsening situation of VC investments. Let's start with the self-fulfilling prophecy. Technically, you don't need any real motivation to start a bank run. All you need is for a critical mass of people to care that a critical mass of people are about to withdraw their money. SVB's career began when Peter Thiel's venture capital firm Founders Fund advised its portfolio companies to withdraw their money from SVB. Matt Levine suggests this because new companies tend to follow. So there are going to be some people who will just blame Thiel and a couple of other VCs for the race. And maybe they are right. Maybe Thiel was just scared by the collapse of cryptocurrency bank Silvergate a couple of days ago, or maybe he had something against SVB, or maybe he just woke up in a bad mood. But I suspect it wasn't just a random occurrence. I think Thiel and others were really concerned about the bank's creditworthiness. A common trigger for a bank run is that people fear that the value of the bank's assets has fallen below the level of its liabilities. Insolvency is not automatically the kiss of death for a bank. Its assets could resurrect and return it to solvency. But if you have reason to believe that a bank is insolvent, you are more likely to withdraw your money because it increases the possibility that the bank will not be around for long. There are a number of reasons why the value of SVB's assets has declined. One is that interest rates have risen a lot in recent months. SVB has invested in a large number of fixed-rate bonds and loans, and when interest rates rise, the price of fixed-rate bonds and loans falls. Another is that there has been a gigantic decline in the tech world over the past year, partly due to a rise in interest rates, but also due to a localized bubble and other long-term factors. This means that many startups are likely to end up in landfills as soon as they run out of money, making them more likely to default on their SVB loans. Fears that SVB was insolvent were raised on Wednesday, March 8th, when the bank declared a sharp write-down of its assets and announced a share sale to raise capital. The write-down alone was not enough to make the bank insolvent, or nearly so, but it probably scared some people into thinking that even bigger write-downs were coming in the near future. In any case, fears of big losses from rate hikes and the tech crisis were likely a factor here. And there may have been another factor here. For normal banks under normal conditions, depositors withdraw their money from banks at virtually random times. This means that, statistically, the net withdrawals in any given month or year are not likely to be large enough to cause problems. But because many of SVB's depositors were tech startups, it was possible that their withdrawals were highly correlated even before the race started. The obvious reason for a big surge in startup cash-outs would be the collapse in venture financing that occurred as a result of the recent tech crisis. With VC funds drying up, many startups had to survive by using their airstrip, burning through cash to pay their employees and other expenses while waiting for the market to recover. But this meant that many startups were withdrawing a lot of money from SVB, while new VC rounds failed to bring new deposits to SVB. To meet these simultaneous requests for money from startups using its track, SVB had to sell assets. Naturally, he sold his most liquid assets first, leaving him with a stack of much less liquid assets. This made it more vulnerable to a bank run. Furthermore, those asset sales may have been what scared some depositors into thinking that SVB was truly insolvent, helping to trigger the actual run. In other words, SVB was just another victim of the tech crash and failed the way banks traditionally fail. What will be the effect on startups, technology, and the financial system? Now let's talk about what the effect of this bank failure will be. The first question, which I'm sure will be foremost on startup founders and employees' minds, is how much money they had saved in SVB can startups expect to recoup, and when? On Monday, each SVB account holder will get $250,000 of their money back, or if they had less than $250,000, they'll get it all back. Next, the FDIC will try to sell off SVB's illiquid assets and use the cash to pay off as many uninsured deposits as possible. Now, there are a couple of different ways that the sale could happen. We often think of a forced sale, where liquid assets with uncertain fundamentals are quickly sold for a fraction of their previous valuation. This is possible here. In such a case, companies that had unsecured deposits with SVB could lose a percentage of those deposits. This is the worst case. But unlike in 2008, we are not faced with a situation where most of the big banks fail at the same time. So far, at least, it's just this strange bank in an unusual corner of the economy. So it is possible that another large bank, such as Goldman Sachs or JP Morgan Chase, could buy most or all of SVB's assets and take over its deposit accounts. Finding a single buyer would make the sale happen quickly, reducing the possibility of panic and contagion, so I'm sure this is what the FDIC is trying to do now. As far as the amount of a haircut depositors might accept on a sale, this doesn't appear to be a situation where deposits will mostly evaporate. Some of SVB's assets are seed loans, which can be difficult to value, but nothing like the Byzantine toxic real estate assets caught up in the 2008 crisis. And many of SVB's assets are just government bonds, which are very easy to value and will have retained most of their value. Therefore, it is quite possible that uninsured deposits will also be completed. Occasionally, the government allows banks to collapse in disorderly and disruptive ways in an effort to ensure financial integrity. The biggest example is the collapse of Lehman in 2008. But the recent experience of the pandemic suggests that the government has learned important lessons. Since 2008, and the need to prevent panic and contagion is far more important than the need to make a group of startups lose 5% or 20% of their money as punishment for putting their money in some weird risky bank. The other big risk for startups, and the reason they're currently panicking, is the possibility that they won't be able to make payroll next week. But while this is undeniably terrifying, I doubt it's much of a danger. First, many companies are small enough that they can survive for a week or two on $250,000. Second, the FDIC has promised to pay SVB depositors an early dividend next week, which will also help payroll. To do this, they will either A, find a buyer for all of SVB's assets very soon, or B, sell some of SVB's more marketable bonds to send depositors enough money to keep paying the payroll until they can complete the wider sale. The FDIC has a strong incentive not to let startups fade away in the coming weeks because they can't pay their employees. It's going to be a nail-biting week or two for startups, but my advice is not to panic. As for the employees, I doubt they will quit en masse, even in the worst-case scenario where they have to wait a week to get paid. These are the life risks of a startup. This also applies to the risk of payment processing companies going bankrupt, forcing new companies to switch to new vendors. The long-term effect of SVB's collapse on the broader tech sector will likely be negative, but not catastrophic. This episode and the general disruption and uncertainty it causes will add to the general air of pessimism that has prevailed since early 2022. SVB has also provided many other financial services to businesses, and it will be annoying and daunting to find new suppliers. And SVB was itself a major tech investor, so its demise will exacerbate the general startup funding crisis. In some ways, this is just another shoe drop in the slow deflation of the second tech boom. On the plus side, more pessimism likely means higher returns for those willing and able to invest, while others shun the industry. Finally, let's talk about the great risk, financial contagion. No doubt many people will have traumatic memories of 2008 when the Lehman collapse triggered a systemic collapse. This is a real possibility, which is why the FDIC and other government agencies will work very hard to make sure that SVB depositors don't have to cut their hair. But there are reasons why this isn't like the Lehman shock. First, in 2008, the big banks were heavily exposed to each other. They had all lent money against the opaque and illiquid mortgage-backed assets they had all created and sold to each other. This is by no means the case for SVB. The financial system as a whole is not particularly exposed either to SVB's debt or to assets on SVB's books. Bank stocks fell on SVB news, but that's probably just sentiment. In general, I am optimistic about the system's ability to contain the consequences of the BLS. So far, the U.S. economy has continued along with record employment and strong growth, even as the tech sector has slumped. There's not much reason to think the underlying model will change after this bank run, and the government has every reason to make sure it doesn't.